Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions, featuring the proprietary bull, bear, point, and figure market breadth summary chart for January 21st, 2018. Market breadth. With this past week's market advance, our bull, bear, point, and figure ratio at 1.60 fell from 1.94 last week, remaining within bullish territory. The total count of securities in bullish or bearish patterns increased fractionally to 3,474. The count of bearish stocks increased 13%, while the count of stocks in bullish patterns decreased 7%. The Pirls PNF Market Breadth Summary Chart shows us a market now 21 weeks in bullish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To subscribe to the weekly Pirls Stock Market Commentary via email, free of charge, simply enter your name and your email address in the spaces provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 58 points for the sixth advance in 14 weeks. At a positive 380.66 points, it has risen above the February 2017 and May 2016 highs, continues above the July 2017 high, and below all four remaining tops in the last 30 months, and continues above all five bottoms below minus 100 in the last 30 months. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 3 accumulation days and 1 distribution day. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week also, the Nasdaq ended in neither accumulation nor distribution mode on higher average daily volume. Momentum. The CCI 20 daily, in a Woody's uptrend, is now at a positive 125.48, down from a positive 154.17 last week. At Friday 12/29 close, the CCI 20 daily was within the plus or minus 50 range, presenting a zero-line reject pivot and long entry signal at Tuesday 1-2 open. We will follow the results of this trade simulation in next week's commentary and plan to exit when the CCI 20 daily falls below plus 100. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 90 weeks ago, while the daily CCI 20 began a Woody's uptrend 3 weeks ago. The CCI 20 weekly at 174.49 is up from a positive 169.48 last week, after forming a zero-line reject long entry signal for Tuesday 9-5 open. Our rule is to stay in the trade until the CCI 20 drops below plus 100. We will continue to follow the result of this trade simulation in next week's commentary. Industry rotation. The last 2 weeks. All of the top 5 industries are positive, and 4 of the bottom 5 are negative. Summary. S&P Retail, KBW Bank, Brokers, and some tech on top. REITs on the bottom. Bullish, S&P Retail and Computer Hardware in the top 5. Oil Services and Oil have left the top 5. Bearish, REITs continues in the bottom 5. Focus this week from www.zerohedge.com. B of A. This is the magic number that will burst the stock bubble. The following are some key points and charts. The one dominant sentiment in the market right now is irrational euphoria, also known as buying panic, as demonstrated in the following Bank of America chart, which shows that in the past 4 weeks, a record $58 billion has flown into stocks. But while it is accepted by virtually everyone that markets are now in the irrational melt-up, blow-off top phase, and even the Wall Street Journal writes, quote, "Melt-up rally propels Dow above 26,000 as fear turns to greed," end quote. The truth is that nobody knows how long this phase can last. Bank of America's Michael Hartnett has come up with not one, but 3 distinct indicators to keep an eye on, which, when triggered, would suggest that the days of the market bubble are finally numbered. First, credit, which, as the chart below shows, is already rolling over. As Hartnett explains, credit is glue, keeping cross-asset bull market together, but flows rolling over and price action looking fatigued. This, to Bank of America, is the clear bear catalyst for us. Second, the wings of Icarus. This is the sundry category, which dumps all possible fat tail risks together, including the risk of economic overheating. Here the euphoria is obvious. January-February investor conviction in fresh upside to stocks driven by 1. Low interest rates, implied Fed, ECB, BOJ tightening next 3 years, 80 BPS, 73 BPS, 10 BPS, and 2. High corporate earnings. U.S. macro surveys consistent with 5 to 6% U.S. real GDP growth. Third, appropriately, 3 is the magic number. Finally, for those curious what others on the street believe will finally pop the bubble, B of A's CIO writes that client marketing feedback suggests the correction will occur only once real GDP forecasts are greater than 3%, wage inflation greater than 3%, 10-year Treasury yields greater than 3%, and SPX greater than 3,000. Thank you for watching this week's Sand to Pirls Stock Market Commentary video featuring the proprietary Bull-Bear Point and Figure Market Breadth Summary Chart compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.